Good morning, good afternoon, good evening, and welcome everyone to what is our very first FutureSet Systemic Risk Masterclass, Beyond the Limit, delivered to you by Lloyd's in partnership with the Chartered Insurance Institute and Lloyd's Market Association. I'm sorry you can't see me at the moment. I'm having a few technical problems with my camera, but I'm sure we'll sort that out along the way. But just by way of introduction, Beyond the Limit is the first in a series of 6 systemic risk masterclasses from FutureSet, Lloyd's new global platform and community dedicated to driving greater societal and economic resilience to the world's most challenging risks. The global platform has been developed in response to the large and complex challenges and impacts arising from the COVID-19 pandemic and the urgent need to begin a new connected conversation with customers, insurers, and government actually to tackle the challenges that these risks bring. So by bringing together these diverse perspectives and through cutting-edge risk insight, intelligence, and cross-industry dialogue on what is the most complex and fast-changing risks faced by communities, businesses, and countries, through FutureSet, we aim to build greater societal understanding and collaboration to find sustainable solutions and support greater preparedness, protection, and resilience to the growing and interconnected risks that customers face today and indeed into the future. So throughout 2021, FutureSet will focus on the landscape of systemic risks, including exploring lessons learned from the COVID-19 pandemic, as well as examining the growing and global risks brought about by climate change. And that's why we're here today and why we have launched the 6-part Systemic Risk Masterclass series in partnership with the Chartered Institute and obviously with the Lloyd's Market Association. So these masterclasses bring together experts across industry, academia and government to help insurance and risk professionals develop their knowledge and expertise in systemic risk in order to support our customers around the world and more fully demonstrate and deliver on our societal purpose. So for us at Lloyd's, that means sharing risk to create a braver world. Ultimately, it is about showing up when it matters most, and that is our promise and that is our product. So when it comes to systemic risk, the insurance industry has a vital role to play in protecting society from the potential impacts by providing security and confidence in the form of risk mitigation and insurance that allows businesses and communities to innovate, develop, and drive economic growth, as well as enabling a quick recovery from disasters by paying claims for insurable events of systemic risk. While the societal and economic impacts of the pandemic are of a scale that we've never seen before, it's shown that a hypothetical systemic risk is never far from becoming a reality, and we must do everything we can to prepare and mitigate against the worst impacts of the constantly changing and challenging risk landscape. As the world turns to recovery, Lloyd's, we believe, has a unique position and opportunity to bring together those communities, those businesses, those insurers, and indeed governments to find solutions to those risks that threaten our shared future. And so the launch of FutureSet sets in concrete Lloyd's commitment to be a catalyst for action, and in doing so, empowering innovation, economic growth, and human progress around the world. At the heart of that necessarily ambitious vision is sustainability, the sustainability of our industry, the sustainability of our customers' interests, and the sustainability of our interconnected economies, society, and the environment. We know that our recovery from the COVID-19 pandemic must be one in which all the decisions we make places sustainability as a foundation and guiding principle. Of course, this won't be easy. Indeed, there is a reason why we, society at large, have only really begun our urgent and vital transition to sustainability. It's because this stuff is really tough and requires a level of global collaboration that until recent years simply has not been easy to foster, because every action has a consequence for communities, for businesses, and for governments. And with some of these consequences being extremely challenging and difficult, it must be acknowledged that for too long, society hasn't gone deeply enough into the debate and the critical actions that we must take. But we have reached the critical juncture on climate, which really started building steam post the 2015 Paris Agreement. In a world undergoing an enormous shift from the tangible to the intangible amidst rapid digitalization in both developed and developing economies, and as economies begin to rebuild in the aftermath of the COVID-19 pandemic, we know we all have a responsibility not actually to build back better, but to build back braver for our futures and for the future generations to come. And that isn't just limited to the environment. It very much covers the S, being social, and the G, being governance. Late last year, Lloyd's published its first ESG report alongside a number of commitments to support a more sustainable market and a sustainable world. When it comes to the E, it's absolutely clear that it's one of the single greatest priorities for us all in the years ahead. And it will require partnership across those various segments of government, industry, businesses, and individuals. You and I, sitting here today, quite simply, that means rethinking our responsibilities and the way in which we work together to tackle arguably one of the world's greatest challenges. Importantly, we have a framework with which to do that in. In the UK, we have Her Majesty's Government's 10-point plan for a green industrial revolution, setting out a roadmap for business and society. And we have governments around the world coming together this year to discuss, accelerate, and lead shared efforts in that respect. The first of which is the G7 summit in June, which will drive a dialogue on how society and economies can build back better from coronavirus and create a greener, more prosperous future. Similarly, the G20 forum this year will be focusing on their three main pillars of people, planet, and posterity. That means taking care of people and of our planet whilst ensuring a strong, inclusive, and sustainable economic recovery. And of course, these conversations and action plans will be brought to the fore as part of the 26th UN Climate Change Conference, so-called COP26, a crucial meeting that will accelerate action towards the goals of the Paris Agreement and the UN Framework Convention on Climate Change. And alongside all of these new and accelerated actions and initiatives will come from these forums, and they're very much needed. We can also reflect on the fact that change is happening, long-awaited change essential to transitioning towards a decarbonised economy. Alongside that change, there will inevitably be new risks that require industry support and innovative products. And while we work towards a much greener future, we must also remain acutely aware and alive to the systemic risks that threaten our shared future and actively work to find ways to mitigate against the very worst impacts these risks can bring. Together, building new and critical partnerships between industry and government, recontracting with one another in the knowledge that working together can only strengthen, not weaken, our resilience to these great challenges. So I guess the oft-asked question is, what is systemic risk, or indeed a systemic catastrophic event? So let me just offer my own reflections here, and of course we'll hear in greater detail from the panel a little later on the same subject. Systemic risks, or black swan events, are the most difficult to quantify, understand, and protect against. As they unfold as a systemic catastrophic event, they can be global in impact, more often than not hit multiple industries, countries, and billions of people simultaneously, with potentially devastating consequences. Their impact requires resources that can only be accessed by governments, with response and recovery requiring international and cross-industry collaboration. The aftershocks from these events mean the human and economic impacts can take years, frankly, quite probably decades to recover from. There is no surprise that the current pandemic covers all of these attributes, and clearly future pandemics, which potentially will be more severe, could have similar or more damaging consequences. Some other examples that we think about of systemic risks include space weather. For example, an extreme geomagnetic solar storm could shut down critical electricity, GPS, and transport infrastructure around the world for days, possibly even months. The impact of accelerated climate change is also a significant systemic risk, the impacts of which could act as a risk multiplier, amplifying the effect and frequency and severity of events such as wildfires, flooding, and other natural perils, whilst extreme local temperatures could lead to permafrost melting or damage to infrastructure. Indeed, in the insurance industry, we have already seen a huge increase in frequency and severity of extreme weather events. Food or critical resource failure is another systemic risk, the impact of which could drive a significant supply chain shock that could have major global economic, political, and social effects. And there are many other systemic risks that include animal disease, widespread electricity failure, industrial disruption, utilities failure, widespread cyber attack. For example, a widespread telecommunications or utilities failure, this could take the form of a global cyber attack impacting millions of devices across multiple industries. and critical infrastructure. So whilst these scenarios often seem extreme, in our highly interconnected society, they may be much more likely than people think. And COVID-19 has demonstrated that society cannot remain complacent and must prepare for catastrophes of a similar impact and duration. Of course, systemic risks are challenging to predict, they're challenging to model, they're so large in scale that they render traditional risk mitigation and transfer methods unfeasible, requiring financial resources which are far in excess of global non-life insurance industry's $2 trillion asset pool. As the pandemic has shown, when a systemic event occurs, given the limited commercial cover, governments step in to protect their citizens. I was checking the numbers. As of January this year, global government fiscal support packages in response to the pandemic now exceed $14 trillion. Together with the economic contraction causing lower revenues, these support packages have led to a rise in public debt and deficits, according to the International Monetary Fund. No surprise there. The fiscal support has been effective, whether through business loans, assorted backdrops, or economic stimuli, and of course remains a viable means of continuing to protect society from systemic risk. However, this approach does not change society's perception of these risks or incentivize greater understanding or mitigation of their impact, and means taxpayers and future generations just end up paying for the cost for decades to come. Although the global insurance industry does not have the capacity to absorb systemic catastrophic events on its own, it is ideally placed to lead and coordinate the work, developing national or regional structures that could provide protection. First, because by ensuring that price reflects risk as an industry, we can drive behaviors to mitigate the impact of such events, such as COVID-19 in the future. Second, our industry's expertise, claims assessment and payment, and risk management can play a vital role in global recovery. So in the recent report we wrote, entitled Supporting Global Recovery and Resilience for Customers and Economies, we set out a number of open source frameworks that could provide customer protection for future waves of COVID-19 and other future pandemics, as well as strengthening societal resilience against future systemic catastrophic events. One of these we entitled Black Swan Re, which was a reinsurance framework for government and insurance industry partnership, which could enable insurers to provide non-damage business interruption cover that offers customers more protection from the devastating and long-term impacts of systemic catastrophic events. This structure would enable industry pooled capital to provide reinsurance for the impacts of future black swan and systemic events, backed by a government guarantee should the pooled assets become exhausted. The design of this structure includes a requirement for initial commercial and industry pooled layer of funds and enabling faster payouts to customers, as well as a buffer for governments before they actually need to step in. So since we've published this and two other frameworks, we've actually undertaken engagement quite staggeringly with 25 governments around the world to discuss their implementation, together with actively participating in a number of working groups across the globe. But we must do more as governments turn from the immediate crisis, thanks to the rapid deployment of COVID-19 vaccines, towards the medium to long-term plan. Critically, we need to work together with governments to ensure that we are never again as underprepared for a future pandemic or other systemic risk. And that means building sustainable solutions to thematic complex challenges to ensure a sustainable shared future. So with that context, and before we get into the panel discussion, I just wanted to briefly cover off the learning objectives for today's session, which are available in full on the screen, and then run actually a quick audience poll. So as to the learning objectives, broadly, you should leave this masterclass with a greater understanding of the role of the government and industry partnerships in protecting society and the economy against systemic risks. Some of the detail includes a look at the definition and examples of systemic risks, the importance in learning from COVID-19 and preparing for the next systemic risk, as well as best practice learnings from industry partnership solutions that could play a key role in future resilience. At the end of the session, we hope you will be inspired to implement change in your organization and across industry as we work together to build partnerships to tackle the large and complex systemic risks bring with them. And if you're tweeting or posting on LinkedIn today, be sure to tag @Lloyds of London using #FutureSet. Now, a few quick moments of your time for our audience poll. you'll see the questions come up on the screen and then have the opportunity to enter your answer. I'll give about 15 seconds for each question, following which we'll take a look at the results coming in. So you can see the first question is, which systemic risks do you think pose the greatest threat to society? So please choose two. Interesting. So the second question is, how well prepared is your organization in respect of systemic risk? Yeah, really interesting results there. I guess we shouldn't be surprised at climate and cyber, or indeed by the suggestion that we've thought about it and we're moderately prepared rather than completely prepared. But it's now my great pleasure to introduce our esteemed panel, for which I have the distinct pleasure of chairing over the next 30 minutes or so. As a reminder, we'll then go to another audience poll and then open up for a discussion, which is your chance to ask questions of either myself or the panel. So I'm delighted to be joined today by three leaders from across industry, academia, and business. From the industry side, I'd like to welcome John Doyle, who's the president and CEO of Marsh. From academia, we're joined by Paula Jalzabakowski, professor of strategic management at the University of London Business School, and Patrick Sterling, RIMS vice president and senior director of legendary people and risk at Texas Roadside. Welcome, John. Welcome, Paula. Welcome, Patrick. So you've heard what I've had to say about systemic risk, but I think everyone joining us today will be much more interested in your views and insights on the subject. So let's get cracking into the questions. Maybe, John, if I could turn to you first. What does systemic risk mean to you and your organization? And are there any particular examples you might want to highlight?
Thanks, Sean. I really appreciate the invitation to join this first masterclass, and I really want to applaud Lloyd's for having this conversation at this particular moment. Obviously, we're all living through a pandemic and all the consequences of that pandemic, and so as you know, I strongly believe the industry's got an important role to play here to improve upon future events, and so again, thank you. I thought you defined it well. I mean, I certainly think of systemic risk as an event that could trigger severe consequences or even the collapse or failure of a market, an industry, or a particular economy. And again, we're certainly living through one right now with COVID-19 and all the fallout as a result of this health crisis. But terrorism, cyber, climate, geopolitics, all to me, other examples of systemic risks that we as a society need to, and as an industry, need to think more deeply about so that we can be better prepared in the future.
Thanks, John. Paula, I mean, systemic risks, as I was just discussing, are so hard to quantify, and their likelihoods just often underplayed. Many people argue we shouldn't have been surprised by the COVID-19 pandemic. So what are the key lessons we learned from COVID-19 as we think about what the next systemic risk might be?
So obviously I've heard that we shouldn't have been surprised because it was on the risk register, but I think it's easy to be wise in hindsight. Nonetheless, it is important to do the learning that we can from this, and I would suspect that for mid-critical lessons that we should be learning from this, and there's a couple of things where I think it plays into some of the insurance industry strengths, are to have a look at that risk register with a deeper consideration and consider some of the things we've learned from this systemic risk, which is a rapid onset systemic risk. So we had very quick acknowledgement of the systemic nature of this, but some of the risks that have just been brought up in the poll, for example, climate change, we do see ourselves running down the tunnel towards that light, and it's a slow onset risk, and we have time to do something about that. So I would suggest looking at the risk registers, getting some sort of time scale on those will give us an opportunity to understand what have we learned from responding so fast to this one. How might we? So if you just think from an insurance perspective about what we know about the difference between slow onset and fast onset disasters. So, for example, a fast onset disaster like a hurricane, we can use some future warning to get people out of the way, but mostly we are in response mode for recovery afterwards. Whereas if we have something like a drought, we can see that coming and we might be able to put in place some aspects of mitigation in advance, or at least supporting people in advance for the disaster we know is coming. And I would suspect that many of the risks that we are heading towards are ones where we could take some analysis of that and understand what are the measures we could put in place in advance. So for me, that would be important. And the other thing from an insurance industry perspective is to have a look at some of those risks and say, to what extent do we have a protection gap for them? Because some of this will already be being covered in a silent way. As we learned from terrorism, we had silent terror. We've now learned we had silent pandemic. Are there other forms of silent, systemic risk on the books? We should look at those and we should distinguish how we might handle them. That's an analytic piece of work, but I believe it is, comprehensible and doable, and one of the lessons we could be learning.
Thank you, Paula. Patrick, might I bring you in and just say from a customer perspective, how aware do you think and how prepared are customers for these types of systemic risk? Patrick, we can't hear you at the moment, unfortunately.
There we go. Sorry about that.
Yeah.
Thanks, John. So when I think about this, it's, low probability doesn't mean no probability. We all were aware that pandemics were a possibility. I think after SARS and MERS, and that didn't really affect the Western world for the most part, we got comfortable and didn't really put some of the mitigation practices into place. Just most of us weren't prepared. Another thing on this one is, over 90% of U.S. employer firms make up small business, and it's about 50% of the private sector employment. And most of those businesses don't have sophisticated risk programs. And so that would lend one to believe that most of business isn't going to be prepared or aware for the future. So that's a couple of my thoughts on that.
Yeah, thanks, Patrick. I mean, Paul, I've heard you talk quite a bit about systemic risk and actually the role that our industry has to play. You talk about a solution being in place for systemic risk with an insurance and reinsurance industry. What do you think we could do more proactively to help customers prepare and protect against this type of risk?
So on the one hand, systemic risk isn't insurable. I mean, by nature, systemic means not insurable, but that doesn't mean that elements of that risk can't be insurable and can't be shared between the insurance industry and, other parties, including the consumers or the citizens themselves. So in that sense, I think that there is work to be done. Obviously, the insurance industry has enormous amount of indirect effects that it can do through pricing signals, and that's been the predominant way that it's influenced areas of growing risk by using its modelling to show that areas are becoming less and less sustainable to insure at an affordable price. I think the insurance industry does and can go further than that, in so much as if we look some of the systemic risks we've just talked about, some to do with terrorism, predominantly to do with things like climate change. There are issues of risk mitigation that can be engaged with. And while normally the job of the industry is to come in after mitigation and provide affordable pricing or to indicate through signals of pricing that this is no longer, that mitigation is needed before we can insure, given that the very fundamental survival of the insurance industry is dependent on resilient risk, then I think it could have quite a part to play in that dialogue of using its modelling, perhaps sharing its data on claims so we know better how risks are escalating and what kinds of resilience might be done, and indeed actively engaging from the private market, not only from sort of public sector risk pools, in the risk mitigation measures and the dialogue around the risk mitigation measures that will make both the society more resilient to systemic risk, but also make the growing nature of risk more profitable or more viable for the insurance industry to continue to play a big part in that.
Yeah, thank you, Paula. John, as you sort of wear a hat, having been both an insurer for many years and now leading, the biggest broker in the world, are we doing enough in terms of education and understanding when we talk about that intangible balance sheet? I think most customers think, goodness me, I own a factory, I must insure it against a fire, or I've got workers in that factory, I've got a responsibility for their actions. Do you think we've got it out there clear enough with the customer that the intangible risk is more prevalent today than almost the tangible risk, and there are solutions out there for them?
John, I think we have a vital role to play, and I think collectively we can do a lot more to help economies and to help businesses better understand systemic risks. To me, looking at the current environment, it's quite clear that economies and businesses have prioritized efficiency over resilience. And it shouldn't be one or the other. We need to find the right balance in our economies and in our businesses to better manage these risks. And, we can certainly help educate, we can raise awareness, we can offer advice, insights, right? We're experts in risk, and we can help develop solutions. When I think of our purpose as an industry, I think about our role to protect markets and businesses and to help prepare them for what's possible and what lies ahead for all of them. And to me, systemic risk is absolutely part of it. As Paula noted, there are certain risks, pandemic being one of them, that exceed the risk-bearing capacity of the industry, but it doesn't mean we don't have a role to play. We are experts and can help structure solutions that don't only provide economies and businesses the means to finance risk over time, we can help improve the outcome of future events, right? I don't think any one of us on this webcast would think that the outcome the next time shouldn't be better than the outcome this time. And so we need to lean in, not lean out, and really do all the things that we do to help manage and improve other risks in our economies and our societies around the world.
Yeah, I mean, the numbers are mind-boggling, aren't they? When you think of U.S. debt increasing by a third in 6 months, and even in the UK where I'm sat, 65% of GDP being borrowed in the same time. That the numbers are just staggering, aren't they? Really? I mean, Patrick, do you think there is a case for government and industry partnerships to work together to address systemic risk? Is that applicable to certain risks and not to others? Do you differentiate for different types of risk? Patrick, I think you're on mute.
Being so good with my mute, but a year in, we still haven't figured this out. So, yeah, John, I appreciate that. You made a great case in your opening on the government industry partnerships, and certainly not all systemic risk are alike. Certainly with TRIA, although it's never been used, it installs confidence, and that's really what business needs, is confidence. To make sure we have the confidence to invest capital, hire folks, and all that. At the time that was put into play, we didn't know how many more of those events would happen. But that was put into play. It's never been used. Certainly RIMS supports a private-public partnership to address business interruption insurance. What we've seen is, as a business here, is that waiting on government to respond after the fact doesn't necessarily work real well. There's been $2.59 trillion already appropriated, and we're waiting on a potential $1.9 billion. But it becomes a political football, and it makes you wonder: are those funds being used effectively, and could there have been a different approach if we were a little more proactive with some type of government industry partnership similar to TRIA? So, RIMS is working with other global risk management associations to ensure that the customer's perspective is including the final solution. Something that I think about, and I said earlier, with so many of businesses being small business, whatever solution we have needs to be affordable for the business at large.
Yeah, Paula, from your research and the discussions with different parties that you've had, I mean, what do you think the key considerations are for establishing any form of government and industry partnership? Is it the breadth of the risk cover? Is it defining different trigger points? Is it excesses? Is it limits? Is it the ability to pay a claim? What's the thought process that goes into that macro type of structure and discussion?
So I'm going to say something here that I hope won't be controversial, which is, I think before we worry about the technical features or the governance features, and I have been studying these mechanisms around the world. We've just heard from Patrick about, the TRIA and some of the sort of features of when government gets involved and so forth. The critical thing for me before you worry about the governance structures, the excesses, who takes which bit, is to make a decision about what is the underpinning cultural approach to this issue. Because the real distinctions that I see around the world are what we assume the role of the public-private partnership is. And if we have a very collective view of this as the primary goal is protecting citizens and protecting local businesses from, the effects of risk, and when we take that as a collective approach, then we have a very different dialogue between the insurance sector and the government. Whereas if we take a very individualist approach, which is individuals should protect themselves against risks, they should mitigate. If they mitigate right, then the market will work. And I think that we can sit in a lot of different places between that. But the point is that when we talk about systemic risk, we have to understand that the ability of an individual or a business to be responsible for mitigating that risk is actually relatively low. So, for example, right now, we do understand that a lot of businesses are closed despite having put in the best possible risk mitigation measures that they could put in place. We will also see that risk mitigation, for example, if you have legacy assets in relation to climate change, it's not totally and solely your responsibility as an individual or as a business that you're getting flooded for the third or fourth time in a row. The secondary effects of climate change are one of the biggest problems for the insurance industry itself and indeed for society in terms of these unprotected risks. So I think we need to start with the very first thing is, what's the fundamental goal here? And is it broader protection, broader coverage for society, and society means economy, then we're going to have a much more productive dialogue. If it's a suspicious dialogue, then, we'll get some patches of cover. That won't be a bad thing. It'll be better than none. But we will see some of the dysfunctions that we do see in some of these systems around the world. So for me, we need to go beneath the technical, because the technical we can do. It'll always be. But if we start with the technical, we'll get lost in the weeds and we'll never get up to what's the purpose of this thing.
Yeah, that's very interesting. I think we'd all nod. They're wise words. I think, John, if I have a bad day, and thankfully I don't have too many bad days, and you and I have had half this conversation before, I sometimes wonder if anybody buys insurance unless they have to. So everyone is told they have to buy auto insurance. You have to buy workers' comp or employers' liability insurance, and is the reason people buy property insurance because a bank's given them a loan and said you must insure the property as a condition of a loan? So are we in a society where people aren't buying insurance unless they have to? And if that's not the case, how do we get over that hump of translating the value proposition that ought to be there to transfer risk from your balance sheet to an insurer's?
Yeah, it's a good point, John. In the spring of 2018, we actually introduced a pandemic BI product into the United States, right? Pathogen RX. It had, unfortunately, no take-up. It was focused, our efforts were focused on, the aviation industry, gaming, hospitality, and, perhaps it wasn't structured appropriately. Perhaps it wasn't priced attractive enough. Perhaps maybe the risk was too far out in the tail for many of our clients to want to transfer that risk. So again, I think we have to bring some balance back into, resilience versus efficiency, right? And of course, again, it's not one or the other. We need to do a great job for Patrick in transferring the risks into the insurance market that we have for him historically, but we need to make a stronger case. And again, I think the industry has a great role to play here in social and economic resilience, which to me is what Paula was talking about. What's the purpose? What are we trying to accomplish here? And social and economic resilience aren't only good for the insurance industry; they're good for all of us, right? And as I said, to me, it's not just about financing the risk; it's about how we improve the outcome of future events as well. And that's where we're experts. We do that. We do that in auto insurance, right? We've made roads safer over time, and we will continue to provide the right structural incentives to do those kinds of things. But if the industry can participate in a meaningful way, as Paula said, we can structure it the right way that we can have a better outcome the next time around.
Yeah, thank you, John. I think rightly we're scratching our heads within the industry to determine how we can serve the customer better. From a customer perspective, Patrick, are there any key learnings that risk management professionals are taking away or talking about at the moment or contemplating implementing with their own organizations? Or what are you hearing?
Yeah, John, it's probably nothing new. So resilience, not everything's insurable. And, resilience is a term that's been used often during this time, and a strong balance sheet has always been and continues to be, probably even now, more important than ever, especially with the world that we're living in. So that's one that is still critical, has been critical, and is probably even more critical. Adaptability. I say that things don't always go the way we want or expect. And so that certainly has happened during this past year. So I would say we've, as risk professionals, we've had to get good at creating calmness out of chaos within our organizations. Other lessons learned is that risk management can't work in a silo, and ERM is such a critical role to build those relationships in advance, to make sure that you are working collaboratively with the entire organization. And this past year, getting really good at active listening and being open-minded. Those are some of the key lessons learned. And as always, the partnership with our brokers and insurers is just so critical on, honest and transparent communication, because it really is a partnership, and collaborating with them is just critical as well. So those are some of the key lessons learned last year.
Yeah, thank you, Patrick. John, just thinking about, because I know you've had quite a lot of discussions with federal government in the U.S. around the challenges and where we might help. And I think we probably feel it in our industry and within business. Those companies that are listed sit in front of their shareholders and they say, what's your long-term strategy? And then very quickly the conversation's moved on to last quarter's earnings, next quarter's earnings. We've got this battle between short-termism and long-termism, and what we're trying to grapple with here are long-term challenges. So do we need to take a different tack with government to sort of say, look, is there a way to incentivize good practice, risk mitigation measures? Are there different ways in which we could encourage business and help business to think about the longer-term risks? Do we need to take a completely different tack to the way we're going at the moment when we talk to government?
John, I would say that a lot of the conversations I've been having and my colleagues have been having with clients during the course of the pandemic have changed quite a bit. Again, to me, it's not choosing resilience over efficiency. We need to, as an industry, do the best job, on the trade, if you will, and continue to focus on efficiency there. But we're having much deeper conversations about tail risks than we have in the past. And in fact, we've developed a tool to to really facilitate conversations with our clients. Risks we haven't historically helped them manage, whether it's cyber, climate, risk, and some of the risks that Paul and Patrick and you have mentioned, as well. I do think the government and I do think investors will weigh in over time on these kinds of events as well, right? I mean, there have been clear winners and losers in the economy. Patrick mentioned the challenge to small business, just as an example, but quite clearly some industries have proven to be far more resilient than others, and those industries are attracting massive amounts of capital.
I think we've just lost John for a moment there, so I might switch to Paula there. Just from your experience, and when you look at us as an industry, you talked about earlier on about assessing and identifying risk. Do you think we've got all of the skills and capabilities that we need within our industry today to be able to consider the right protections that we should be offering society? And if not, what advice would you give us?
So for me, I think the important thing about the insurance industry, and I'm a believer in insurance, is that it does have a lot of technical skills, and the more that we face catastrophic disasters, the better that the insurance industry is at understanding specific aspects of those disasters, because its modelling has become really very sophisticated, and also increasingly we have more sophisticated financial instruments that can come in at different points in the disaster response, and that can offer cover or protection in different ways, from sort of cash injections or liquidity to deal with perhaps unknown things that we might want money for, versus sort of reconstruction. So I think there's a lot that we have in technical capability. There's a lot that we have in the financial products that we're able to deliver. I think there are some things that are really important to invest in, which would make those things more accessible. Part of the problem is that those capabilities lie within organisations that understandably see them as part of their IP, their competitors. So the idea of how much of that gets shared or used easily for other societal goods that would also be good for the insurance industry is one of the sort of things that we need to break down. I do think risk pools are one of the ways that we can do that, because they can transform knowledge and make it accessible to their members, the insurance companies, but also their consumers, the clients. So that's one way that you might make better use of your risk pools. The other thing that I said, sort of for knowledge development and sharing, but the other thing that I think is very important, and it's something that this industry perhaps hasn't invested much in, is socio-political skills. And getting to not to just know the customer, the premium paying customer, but engagement with the communities that are being infected. And those communities are multiple different types of communities, understanding what the disaster means to them. So looking at it through their eyes, not through your eyes as an insurer, will make you able to develop better solutions for them, as opposed to sort of, it's very easy to see that when you have a systemic risk, one thing you can do is say, well, they didn't buy the right product, we should put the prices up, we should develop exclusions, and then we should just deliver an education program to teach the consumer. And yeah, okay, there's a reason to say that, but actually if you understood what consumers understand and what they their experiences, then you might actually be able to work better with them in something that, and systemic risk is going to require a much more holistic and joined up way of doing this. And I'd love to see the insurance industry be really active involved in that, because, my idea of a perfect world is everybody's insured. It won't cover everything, but it means that we are all providing for each other, and we also know what's left over, and we work out other ways to manage that. So, in that sense, I believe in insurance, but I believe that insurance needs to get much more integral to society, not just more and more technical, which can actually make it more and more remote from the experience of risk by consumers. Yeah,
Patrick, so picking up on Paula's point there, do Do you think the industry does a good enough job of spending time with the customer and really understanding what they want to buy rather than saying, here's a product, please go ahead and buy it? Is there enough effort going into really understanding what the end customer wants and needs?
Good question, John. I mean, I think that depends on the relationship manager with each customer. So I think some are better at it than others. Some brokers have industry-specific groups that do pool resources to really get that knowledge, and so I think some are better than others. So I think some are doing a really good job, and some could do better.
I probably should have asked you that question, really, John. I'm just reflecting on a few approaches I've had from friends who've rung me up and said, can you read my policy wording and tell me whether I've got business interruption cover? And one was a farm and land policy. It was 126 pages long. So I do wonder sometimes whether we're doing enough, as an industry at the front end to sort of afford the cover and not present ourselves in an overly legalistic way. Is there more we can do? I think John's frozen on me as I asked the sort of tricky question of the broker. Paul, you talked about pooling vehicles and industry partnerships. You think they can be well applied to the systemic risks? Do you think that's a good concept, a valuable concept that we can bring into play more?
Yes, I do, in so much as, I think we need to improve the pooling systems that we have. I think we should learn from what we've got and we should improve them and we should look at the purposes of them. But yes, I think they are one quite effective vehicle. And since we already have something that we know how to use, it makes sense to me to learn from that and extend that rather than try and invent something new, which will ultimately have to involve some form of sharing anyway between the public and the private sector and across the insured population, whatever that might be, be it business or individuals. So, yes, I actually think that they have a place to play. Clearly, they can't deal with all of systemic risk. Systemic risk cannot be fully insurable. It's the point of it. But they can help to smooth pricing. They can help to spread cover more widely. They create a premium buffer in periods of time when the systemic risk doesn't trigger, or when we don't quite know what a systemic risk or what the next trigger will be. That also could be vehicles through which those premium buffers and accumulated premiums might be invested into some of the work done to think about how we deal with these systemic risks. They might be vehicles as well for some of the dialogue we've talked about. So I'd like to see us use them for more than just plugging a gap in the risk transfer chain. That's largely what they do in many societies, but for some of them, it's actually a much more comprehensive approach to, resilience as well. And I'd like to see that aspect of it built out more because I think it's something that they are quite uniquely placed to do.
Yeah, thank you, Paula. I mean, when you talk to customers, Patrick, is there any sense with specific industries as to whether industries see an opportunity for them to pool their resources and think more broadly about some of the more complex risks they face rather than think as individuals? Is that a conversation that you're hearing taking place?
John, I haven't heard that in our industry as far as pooling those resources for cover. I think what we're looking for is that government industry partnership. And I love some of the things that Paula has said. I think she's right on and how that might look. And what I always say is that what we're looking for isn't necessarily full transfer of a risk. That's just not realistic, but more of what I would call a bridge to recovery. Would be very, very helpful. So sometimes it's just like, hey, we need a little bit of that bridge to adjust our business model, make some of the investments that we need to make to adapt to for a time. but it's just that bridge. So that's what a lot of us are looking for, but haven't heard of any pooling of resources.
I think, thinking along that sort of same theme, Paula, you raised an interesting topic around educating communities. For some of the scenarios that we talked about right at the outset of this discussion, do you think there's a role for community insurance programs? Is that part of the solution?
Yes, so I guess there's two things that you just raised there, which is educating and communities and also community insurance. I'd have to think a little more on community insurance, but I think it has some exciting potential. If we think about sort of some of the things, let's say, who's the front of risk, if you like? Well, we've got a lot of flooding going on in the UK at the moment. Who's the front of that? It's local authorities, it's people in communities. We do know from work on resilient communities, where communities themselves are involved in the decision-making and where local businesses are involved in post-recovery, that we actually end up with better quality resilience. So it seems to me we could also look at some forms of communal or community insurance, perhaps sort of double layers of insurance. That's a slightly different thing to educating the community and hearing the community's views. And I think so. I think we've talked about both of those with that scenario. And I definitely see a place for the educating, and educating has to be a bit two-way. It's not we know and we're going to tell you what you should do. We listen, we hear what we need to do differently. But I also think you're offering some intriguing possibilities there, because after all, insurance was based on sort of solidarity and community early on, that maybe there's a role for some sort of communal or community insurance. So, yeah, thanks, actually, John. You've triggered my imagination.
I'm pleased to have done that, Paula. And I think all ideas welcome. I think John's back with us. I might go back to that question earlier on. Are you there, John?
I think I am. Can you hear me, John?
Yeah, we can hear you. I just went back to that earlier comment I was making, which, unfortunately, because you're in the industry, a friend or two asked you to look at their policy wording and say, can you advise them? And I'm still reeling from 126 pages of the farm and land policy document, which took a bit of working through, I have to say. Is there something when we think about the way in which we represent the offer that we're presenting, even for the most complex of risks, where we ought to be able to articulate it far more simply than we do? You used auto insurance as an example earlier on. Most demands and needs statements for auto insurance are on one page. Yes, there's a policy document behind it. Do you think if we made a difference in the way in which we represented the product and the service proposition, more people would think that there's a value to buy?
Yeah, it's a great question, John, and certainly, the number of policyholder disputes that, have resulted from, the pandemic would suggest there's a lot of room for improvement here. And so, to me, simpler, product offerings, stepping back and better understanding and having a good conversation between, all three parties around what we're trying to accomplish here, certainly is very much, required. I mean, we, for the most part, obviously don't offer named peril policies. I mean, they do exist in certain cases, and I'm certainly not an advocate for it. But, we just talked about a number of systemic risks over the course of this webcast. And, silent cyber, for me, is a great example of a discussion we need to have as an industry and need to, be much clearer so that our clients really understand what they can expect and how the industry will respond should we have a systemic cyber event, right? As Paula pointed out earlier, there's no cyber exclusion in many policies, and that's, we have to recognize that as an industry and step up as a result.
Do you think that's a risk for us as an industry that actually, at the same time as talking about covers that we should provide, John, there's quite a risk that there are covers inadvertently that are providing that the industry simply can't absorb? You talked about silent cyber. Do you talk about other risks that are there embedded in covers that people probably don't appreciate?
Yeah, I think that's probably the case, right? I mean, the economy evolves, risks evolve. It's one of the great things about our industry, is how dynamic it can be and how responsive we generally try to be. But in the case of cyber, it's clearly a conversation that we're having with our clients, and it's something that the industry needs to confront as well.
Patrick, do you get a sense that particularly the larger clients are retaining more risk and perhaps taking greater risk than they can really understand or comprehend? Do you get a sense that there's more risk being taken on balance sheets, which may actually create a more significant problem than we can see down the line?
Well, I would say somewhat we are taking more risk, just with the hard market has forced a little more risk taking as far as that goes. But as far as systemic risks, I wouldn't say that we're taking any more. I would say that it's still a little bit of the unknown, almost what John just said with cyber. Do we really even know what risks we're putting our balance sheets at with some of these systemic risk, and how our policies would or would not respond? So the only risk that I see that people are taking more would be just on the hard market and just taking on higher retentions or no cover at all.
Hey, John.
Yeah, the time.
I would add, we did see growth in our captive management business during the course of 2020. We saw, a pretty good uptick in the number of new captive formations, and even with existing captives that we help our clients manage, they've moved more risk, more premium into those captives during the course of 2020. How long that lasts, whether that's a trend or whether it's a hard market reaction, maybe as Patrick pointed out, only time will tell. But we've certainly seen an indication through our captive management business that our clients are taking more risk, and that's of course aside from just given the price and coverage discussion we're having with our clients, at the moment, and given the economic consequences of the pandemic. Many are still transferring certain risks into the market, of course, but they're buying less coverage, taking higher retentions, taking co-insurance, those kinds of things. So there's no question the economies of the world are assuming more risk as we navigate through the consequences of 2020.
Yeah, that's understood. Thank you all. Just before we get some more questions, I think, coming from the audience, which would be great to answer, perhaps we can just run another poll with you, similar to the first round. So you will see the questions come up on the screen, and then you'll have an opportunity to enter your answer. Same as before, I'll give about 15 seconds for each question, following which we'll sort of take look at the results as they come in. So first question is, to what extent is there a role for government and industry partnerships in protecting society against systemic risk? I'm not sure I can see the answer coming up just yet. Is there an answer coming up on this one for us? Here we go. Okay, second up is what are the, so second question, if we move on to that one, is what are the key skills and capabilities we need to invest in as an industry to protect society against these types of risks? And again, as earlier on, maybe you could select two from the list that you can see. Interesting. That was really quite well spread, perhaps more broadly spread than I thought it would be. What I'd like to do now is just to move on to an audience discussion, really. This is your chance to submit questions and comments using the Q&A function that's available to you. So we'll try and get through as many as we can in the next 10 minutes or so. Just might be worth, whilst the questions are coming in, just a thought to each of you on the panel, and I'd reflect as well, having had discussions with government. I mean, everyone says their government and industry partnerships must be part of the solution. Certainly we found, and perhaps understandably, the governments have been just too busy to engage in any conversation really beyond the very short and immediate term. Do you think that's going to change, Paula? Do you think you'll see governments want to come back and look at partnerships with financial services, particularly in the insurance industry, for tackling systemic risk?
I really hope so. I think that what we're seeing and what we should be aware of is, yes, to set up something new right now when a government is also frantically scrambling with a whole range of things it has to deal with is probably not the space to go. But I do sit on other forums as well, some of which are, deal with places that have risk pools that are more embedded into almost a nationalized risk approach. And within those situations, what you're seeing is already a view that, yes, it's too early for the insurance industry because we haven't got a handle on this, but that this is a risk that ultimately this type of risk that we're seeing now, this is a risk that will create a protection gap because of exclusions. Nonetheless, there's a lot of loans going on and so forth. Somewhere we are going to need people to have cover for this in order to continue to have credit to continue to trade. We have actually been quite successful in a couple of things in this country with the film and TV industry and with trade credit in getting a government and industry sort of cover going immediately. So we can do it. What we're seeing is that places that have a strongly established approach to the government risk pools are already considering when this might start to get passed on to the risk pool. Here, perhaps, we're more firefighting, but we've done it very successfully with a couple of important areas to the UK for different reasons. And I think that if we can segment and do a bit more of that, I'm very hopeful that the lesson that we'll get out of this is ways to strengthen that dialogue and ways to make that a much stronger feature of planning for protecting and the bridges that Patrick talked about earlier, creating that bridging mechanism from protection to resilience.
Yeah, thank you, Paula. The question coming in, which I might direct at Patrick, and it's a question of whether the insurance industry does a good enough job of actually explaining what it is trying to do as it looks to get and demonstrate its value proposition for risk mitigation, risk protection. Do you feel, in addition to implementing new solutions for catastrophic or systemic risk, we've got a bit of a job to go back to the basics and educate the public on the fundamentals of the value proposition of insurance?
I think the insurance industry does a good job, and I wouldn't say, I don't think we can fault the insurance industry for this current pandemic and all that went into that. I mean, I think we were all in the same place, as I said earlier. We knew about it, and none of us were prepared. And maybe that includes the insurance industry as well, but I can't fault them alone. I think we're all in this together. But that being said, I think we do need to get better at horizon scanning and thinking more, and I think as John said earlier, kind of that cyber. And, are we prepared for that? How would we respond? How would our policies respond if we had a systemic cyber event? So we've got to get better at horizon scanning versus just looking at historical is kind of what we do and get exclusions in policies, everything gets adjusted. But be more forward looking is an opportunity. But we need to do all that together. I wouldn't put that just on the back of the insurance industry.
Yeah. I'm picking up on that a little bit, John. Do you think, as an industry, we do enough to incentivize good practice and risk mitigation measures at the customer's end? Is there more that we can and should do to help in that respect?
Well, I think, John, the industry does a nice job in the traditional risks that we cover in sending, pricing coverage signals to clients, all over the world. But, I think the opportunity in front of us now to add greater value than we have historically. And look, I think, again, I want us to learn and get better from these events. Historically, there's a great purpose to what the industry does. About protecting and promoting possibility is what we talk about at Marsh, and I'm very, very proud to have devoted my career to those efforts. But again, I think we've focused on the traditional risks that we've helped clients transfer into the market and can do a better job creating solutions. Again, those solutions may not rest on the industry's balance sheet entirely, but to create more resilient economies and societies around the world. And that's a big opportunity for us. And, it's why Marsh McLennan has leaned into this discussion and having very constructive conversations with many governments and with our industry partners all around the world. And I'm optimistic that, we'll develop some good solutions that may not be perfect, but will be better than, and will be better prepared than we were this time.
But Patrick, do you think there's more, we talk about government partnership, do you think there's more we could do to facilitate a better cross-industry collaboration to solve some of these challenges? Do we need a bit more self-help as an industry? Could we help to gather together collections of industries and customers to say, hey, what can we do together to help solve this problem for ourselves, and then go to government when we've got a solution for their support? Is there a logic in turning the conversation the other way around?
Emphatic yes. So I think that is an opportunity. I mean, certainly the more we can be together and the more people we can bring together, and certainly the insurance industry has a unique perspective because they have such a diverse group of businesses. They represent everyone, and we're all impacted by this. So I think to come together, not just nationally but globally, would be a powerful force for moving forward on a public-private partnership, which I think we all agree is critical for these systemic risks. So emphatic yes to that question.
Yeah, Patrick, thank you. I mean, there's a variation on that question coming in, asking what is the likelihood of the government and the insurance industry partnership to address future pandemics. I can say from my discussions, not immediate. There's no government that's really looking to get involved in that solution straight away, and hence we're trying to think, what can we do now within our industry to solve against the problem when we come out of national lockdowns and the like, and we have some thinking and some ideas in that respect. Do you think that will happen, Paula? Do you think there will be a preparedness for the government to think about the contingent exposure it's carrying on its balance sheet and wondering whether the insurance industry can help?
Well, yes, I think there are some consultations going on right now, in fact, that would indicate at least the opportunity to just create and shape that type of thinking about, including, I believe recently the government advertised for some sort of contingent risk director or something to bring together some of these parties. And I think that for me, that's a really positive sign, because it signals we need to do something new, we need to do something more. At the same time, I'm encouraged by some of the things we see. For example, at the moment, we do have the flood pool, flood re, and there's sort of a consultation going on around how more Build Back Better and other kinds of flood resilience incentives can be built in. So I think we have a few things we can see going on, and let's hope they're not just at the fringes, because let's hope that they're going to become central to the dialogue of managing a growing portfolio of risk in this country. And that obviously insurance as a key risk sector, and this country as a key player within that sector, that insurance is a very central to that set of discussions. So am I saying I think it will? I'm hoping it will. I think there are some signs that is that's growing some momentum.
Yeah, Paula, I had a call on that one. I think as Paula said, in the UK, the government's looking for a director to assess the contingent liability on its balance sheet. I had a call on that for some advice. So I said, well, she or he needs a pretty damn big calculator when they come in to work out what that liability looks like. I wish them luck. Do you think, John, as you were thinking...
Sorry.
Yes. John, do you think, as we look more broadly into financial services, do you think alternate cover structures, whether it's parametric products or tapping into the sort of wealth of capital that's actually got nowhere to go now as the world stares down the barrel of negative interest rates, is there different types of capital products that we could bring to bear within the insurance sphere that would add to the capability and the capacity to solve the systemic risk problem?
Well, I think certainly, John, in the case of pandemic risk, liquidity is so critical. And I think generally speaking, that's going to be the case with other systemic events. So I do think parametric triggers can be very, very useful. And, it's certainly, again, in the case of the discussions we're having with governments around the world, when we get a few steps down from what, Paula was talking about, kind of the higher purpose of what we're trying to accomplish, we very quickly have gotten to parametric triggers so that we can inject liquidity into the system, quite quickly, to avoid collapse, right? And I think, another important consideration is that, we're not really thinking about using the industry to administer aid, but to, again, help protect risk and improve risk hygiene over time are really important considerations. But parametric triggers are important. I think we can ultimately, if we create a real baseline, of cover, for economies in different countries, we can then bring other capital, up and above it as well to provide other solutions. Patrick pointed out, one of the critical issues, here in the United States, 50% of those of employed individuals are employed by small businesses, right? And they're clearly not as resilient, don't have access to capital, the strength of balance sheets that big business generally does. So anyway, we need to think through all of those considerations so that we can accomplish the bigger goals that we have in mind.
Thank you. Yeah, thank you. I think there's so many more questions coming in, but I'm conscious that the clock is counting against us here. So I think I'm going to say thank you very much for what was a lively and really interesting session. So as we wrap up this, our very first Future Set Systemic Risk Masterclass, I'd like to pay very grateful thanks to John, Paula and Patrick for joining us today to share their insights on not just systemic risk, but a whole range of different subjects. And most importantly, to everyone that's connected in today, thank you all for joining us. It's been a pleasure to kick off the series. So, as I mentioned at the outset, it's really imperative that as we begin to recover from the COVID-19 pandemic, we do so with sustainability at the core of all of our thinking. There's never been a more important moment for our industry, and as we've discussed today, even therefore for governments to partner to protect society against the impacts that we're now beginning to properly understand. And I have no doubt that everyone, as part of this webinar, will want to be part of that effort. So following this session, you'll receive an email with further information and resources that will help with the discussion that we've had today and some of the learnings that come from that. And we'd obviously love you to join our FutureSet community, and you can do that by going to www.lloyds.com/FutureSet. So we have lots more in store, 5 more masterclasses to come, and you can find all of the detail there on the website and register for any subsequent sessions. And we'll look forward to seeing you again soon. So again, thanks very much to our brilliant panelists. And in the meantime, everyone, stay safe, stay well, and take care.